former US Federal Reserve Chair Ben S. Bernanke has just won a Nobel Prize for Economics, though heaven knows what for in my humble opinion, and the timing of that gong is interesting because central banks' power over the markets and their independence from politicians may be coming into question for the first time in 4 decades. As currency, bond and stock markets remain febrile and economic outlooks gloomy, policymakers face their next big challenge as the European Central Bank makes its next announcement on interest rates and other parts of its toolkit. The ECB will outline its latest policy decision on Thursday the 27th of October. Frankfurt's finest was frankly late to the party as it only announced its first interest rate increase of the year and in more than a decade in July. However, President Christine Lagarde did at least move the headline refinancing rate by half a point to 0.5%, and she then followed that up with a 3/4 point hike to 1.25% in September. This time around, markets are expecting another 0.75% increment to 2%, and that were the highest level for the headline refinancing rate since February 2009. Even then, interest rates would still be hugely negative in real post-inflation terms, since inflation is running at around 10% across the EU on average. The ECB's still got work to do if it's to return inflation to its mandated 2% level, and economists and investors will therefore also be looking for more details on the bank's proposals for quantitative tightening. Christine Lagarde and her colleagues have so far rather fudged this issue with talk of an anti-fragmentation mechanism to help the more indebted southern European nations should bond yields start to rise once the ECB starts to shrink its balance sheet and sell some of the 7 trillion euros worth of bonds it's acquired since the launch of quantitative easing in the wake of the financial crisis over a decade ago. That talk of anti-fragmentation devices, well, it's not really convinced anybody yet, and as the Bank of England and the US Federal Reserve are finding out, turning QE into QT is not easy, at least not without causing some dislocations somewhere along the line, either in terms of economics, financial markets, or both. Back home, politics may continue to dominate the headlines, but there'll be plenty of company news for investors to study as well. Names which may be worthy of further research include the following, although some of these dates could still be subject to change. Pearson on Monday the 24th of October, HSBC, Whitbread and Shoezone on the 25th, Standard Chartered, Fresnillo, WPP, Elementis and Bloomsbury Publishing on the 26th, Shell, Unilever, Lloyds, Anglo-American, Aveva and Renishaw on the 27th, and Glencore, Computer Centre and NatWest on the 28th. But it's another bank, Barclays, which could just cause the biggest fuss when it reports third quarter results on Wednesday, the 26th of October. The shares are trading at 18-month lows amid worries over the mortgage market, the UK economy more widely, and also how the investment bank is doing as markets become more volatile, though that could be good, and deal flow dries up amid that volatility, which is usually bad. The headline number to watch is pre-tax profit. Analysts are penciling in £1.8 billion for the third quarter. That compares to £2 billion a year ago. For the first 9 months, pre-tax profits therefore seen reaching £5.5 billion, down from £6.9 billion a year ago. One big swing factor here is the second quarter's £1.3 billion fine from American regulators for product mis-selling, but analysts will then look to 3 other key swing factors in the profit and loss account. The first is net interest margin. Higher interest rates, or at least wider credit spreads, could help Barclays here, and in the second quarter the net interest margin at Barclays UK was 2.71%, higher than in Q1, so the tide may be turning. The second factor is loan provisions. Loan losses were small in the first half, but they have started to creep up again, especially relative to 2021, when Barclays wrote back some of the provisions it took in 2020. Analysts are looking for another small increase of £330 million in fresh provisions in Q3, but the IFRS 9 accounting standard could make life difficult here, as banks must now also try and think about expected credit losses. They can't just wait until a loan goes sour, they have to make an estimate for a loss if they think it could go sour. That's going to be pretty tricky at a time when UK consumers are seeing energy and mortgage bills going through the roof and their pockets being squeezed. Remember, Barclays has got a £160 billion mortgage loan book and an £8.8 billion credit card book. Finally, analysts and investors will look to the investment bank and how it's performed. Activist investor Edward Bramson of Sherborne Investors got nowhere with his calls to spin off the investment bank and break up the group. But even allowing for a bumper 2021 and first quarter to 2022 might not be too wise for Barclays shareholders to do a victory lap just yet. Earnings slumped in the second quarter to £784 million at the corporate investment bank, though analysts are looking for a jump to just over £1 billion in the third quarter. Barclays probably won't talk about dividends, as that tends to be a topic for discussion at the half and full year stages. But it is continuing to run a buyback scheme, and that's the latest one. We've got a value of £500 million to top up an earlier £1 billion scheme. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.